Good morning and welcome. Sound check, please. All right, if you go to your Documents tab, you will find a that we have uploaded the weekly thoughts starting for the month of June, and it is in the marked as weekly thoughts 6/1. All right, so I think it's interesting that I couldn't have timed this better. One of our students had sent me a PM saying they had a great month, but they still need to manage the risk and time entries, and that's probably part of the weekly positive thought. Traders need to focus more on the risk of a trade in order to determine position size. That's the real key in why using directional option strategy gives one a better rate of return. Because if we can time, and that's the key, because when using options, timing is everything. And if we look for a big move in a market, we have to have several things. A high probability setup. We have to have some maybe clues that there's potential ammunition for the market to move. And those clues would be if we're looking for an upside short reversal to the upside, we need to see if maybe there's speculators that are caught short in the market and they would cover and buy. And those short covering pops are very, very lucrative. And there's one technical, or I guess you want to call it a report, that would give us that information, and it's the weekly commitment of traders data. That helped us last week in determining crude oil and where it might bounce down to in that mid-56 region, as we discussed that many speculators had gotten long at around the 60.5 area, and we said, you know, anyone that can take a $4,000 move against them on a one single contract position, that's probably enough heat to kick them out of the game. And so we did see a nice surge to the upside last week, short term, in the crude oil market, as it's in a seasonally strong period of time. What a coincidence. Now, we are looking at this week. If you take the time to read Market Thoughts and Observations, we do have a conflict between different trading platforms and algorithmic situations. This is Genesis here, and I want to focus in on the daily markets. The daily markets, as we can see, we're going to take one at a time real quick. The advanced decline analysis, our cumulative advanced decline line, if I try to zoom this up, you'll see what I'm referring to. We started to break down, and we actually made a new lower low in the advanced decline. The volume made a new OBV daily lower low, and it was underneath that moving average. To me, that's not a very positive short-term sign. So while the market on Friday, we also had a quasi-doji formation here. We made a lower closing low. That's typically not very positive, and who knows, maybe the market can open a lot lower. Thus the reason we were saying, if long, tighten up, especially if you don't have a lot of strong profits in a trade. Like if you just got in a trade and it's, you know, slightly in the positive, and you have a close stop, sometimes the markets will open and gap lower, giving you a tremendous amount of slippage. And when you get into a situation like this, where you're starting to see the technicals not really look positive on a short term, you know, your best bet is to just say, you know what, let me get off that train ride. That was what we did with, which really doesn't have a lot to do with the trading room, but one of the things that we sent an alert out on PA stock alerts to lighten up positions, and especially under those situations where profits are, you know, negligible. You don't have a huge base of profit, and you don't want to have a huge slippage in stops if the market gap lower. This is the NASDAQ 100. We definitely generated another, but we've seen in the past that the low close dojis are not really effective. We get a low close doji and we open higher and trade higher. And today, as you know, the NASDAQ and the S&Ps are a little higher today. But we're starting to develop sell signal after sell signal. But what's kind of interesting here is that we did actually break a low in the advanced decline. In addition, we broke a volume level. What I really don't like about this market, or what it might be setting up for this month, is that we are seeing a little bit of bullish higher highs, but it's on lighter volume. And in addition, we're starting to see a rollover or liquidation. And this, to me, is what the market might be sharing with us, that there's a lot of illiquid market conditions in equities. In other words, the market rallies, and it rallies on insignificant volume, and then they sell it and you're starting to see lower tiered, and that's what this could be. This is a capitalized weighted stock index, the Qs. So higher capitalized stocks have influence on the pricing structure, whereas lower capitalized stocks, which are numerous, are starting to liquidate. So to me, this is more indicative of a distribution type topping pattern. And again, tops take longer to form than bottoms, number one. Number two, tops definitely are a little bit trickier, as we discussed and discovered last year. In August and September, there were a lot of people who were very nervous, and we were calling for a market to break down, and the market did finally break down, but it took time. That was back, and I'll change this over here and just demonstrate what I'm referring to. So we even had this, and you may want to go down and scroll down and view the tweets. We said this is actually a very difficult trading pattern. It's called a broadening top. Some people call it a foghorn. I gave a presentation and had someone rudely correct me and tell me it was a megaphone. I remember that one distinctly, and I had to remind them, hey, this is a one-man show. You're in my house. If you want to interrupt me again, you can leave. The moral of the story is the correct technical term was called a broadening top formation, and just because someone renamed it doesn't mean that's correct or incorrect. It just means that whatever you want to call it. It looks like a foghorn. It doesn't. It looks like a broadening top. Market makes higher highs, the market makes lower lows, and tops, which is the old term, takes longer to form than bottoms. The interesting aspect is, as the market was making those higher highs, it wasn't seeing a huge accumulation. It was more distribution. Note that as price was kind of grinding higher, we were not seeing a huge accumulation in stocks in the AD line, nor were we seeing, in fact, if we zoom this up, you were seeing a more of a bearish divergence in the volume pattern. And so as the market was up there making new higher closing highs, you see that divergence in the AD lines, and then all of a sudden we started to take time before a nice, what I would call, meltdown, which we were maybe in a little bit early, but yet we're able to profit from. And, you know, not a big deal, but it was about a 10% stock index correction in less than a few weeks. Ironically, we actually flipped and went long in the IWM, if you recall, during that time. Tools that we used to help us with this was, in fact, what you see on your screen. What does that got to do with the current market environment? Pretty much everything. And the reason I say that is because we are seeing that probably more so than ever, volume illiquidity. And that, I think, as you can see here, there's no one to distribute the funds, the issues to. When you get to illiquidity market conditions, what happens? You have no one to distribute the supply to because there's no demand. So if the institutions run the stock up, they generally like to sell it to the public. And this is one of the few rallies in probably a number of decades that the general public has not joined this party. So all that's really going on is markets are moving from one institution's hands to another, and it's sloshing back and forth, and that's why we've been getting this, what I've been calling for the last several years, and many of you now are familiar with the term, sector rotational market. And then we've not just done a sector rotational market, we've done a index weighted sector rotational, where we've gone from blue chip stocks to small cap stocks back to biotech and technology weighted indexes like the Qs, et cetera, et cetera. So when I tell you guys that, and I try to share with people, this might be that confusion in the marketplace, it is eventually going to resolve itself, and with not just one index reflecting a decline. I've got the S&Ps in a volume decline and an AD line decline. I've got the Qs in both that type of situation. I've got certainly the Russell, which has been in a daily sell mode. And one of the interesting things, the Russell's been the strongest from a volume perspective. It started last week to cave, and we made new lower lows in the OBV. So as you note, as we go through the summer months and into June, we start to see weakness from a seasonal perspective, from a historic supply-demand tracking methodology, and that's what seasonality tool shows us. What is the average change in price percentage-wise year over year, and you average that out and get a seasonal trend tool. You can't take an average price trend because an index from 30 years ago might have been at a value totally different as it is, right? We have to take percentage and change terminology or in percent change terms. But looking at the advanced decline, it's if you were looking at this purple line, you'd say, gee, this thing's not going anywhere. In fact, it's kind of arcing over. It's not bottoming under. It's not showing a rounding bottom. It's showing more of a longer term rounding top. And so is the volume. And to me, that's while there might be some upside left in the market, and we could see two-sided trading, it is evidence that the market is rolling over right now. So when we take a look at the NYSE as well, we see this very similar pattern. I mean, this isn't just one stocks index. This is several stock indexes. Unlike any other time in the last, say, 2 years, whereas one stock index was stronger than the other, this is one now that I've gotten 4 stock indices that all have a very similar pattern. The AD lines are rolling down, the volume is rolling down, and to me that shows more of a distribution top on a massive scale. So let's take a look at the daily charts. The daily charts on the diamonds, and last but not least, wow, same type of formation. In fact, what's scary about the Dow or the diamonds is that we did make higher highs, and from that point we did see quasi higher highs in the advanced decline. Now that's not hard to do, it's only 30 stocks, but boy, we didn't see any follow through in volume, and that might be why there is that quote unquote, if you hear on the news, illiquidity. They just have no one to sell it to except for each other, and if they decide to get out or lighten their load, we're going to see the market roll over to the downside a little bit deeper. Now let's change to the higher degree time frame weekly, and you can see we have kind of a different makeup to a degree. Longer term weekly still is in an uptrend, but relative to its highs last year, it's showing divergence longer term. Now when I change this to a monthly chart, the monthly price action looks strong. The AD lines are flattening out. Volume hasn't really picked up since, let's call it, November of last year. Since November, we have made new higher highs, but on lighter volume. So when we get into the end of May and into June, while we might see two-sided trades, the longer-term trend is still intact, but what comes first, the chicken or the egg, short-term or long-term? Of course, short-term. So we now need to monitor this market to see if perhaps this was maybe just some end-of-month liquidation amongst every single stock index on a daily chart. That I don't believe, but needless to say, I think both the volume and the breadth analysis suggests or gives us maybe too much detail, but it is more evidence that we are seeing more of a liquidation distribution type environment right now, and versus more or less of the sector rotation. That's what my take is in all of the market analysis here. So with that said, when we look at what stocks to buy for this week, I would be honest with you. We have some utility names that typically the utilities bottom in February, March through April. They bottom there. This is a multi-utility name. Tegris, I believe, is the company. And as you take a look at this, Integris Energy Group, when you take a look at this, you go, well, the daily volume doesn't look great on this stock, and it is an interest rate sensitive issue in utilities. They have walloped the market a little bit from its peak at the beginning of the year, but notice that when it was in a seasonally strong period of time or basing, it did just that. It based. It's in a weekly buy. The volume action on a longer term monthly looks good. And then so I start looking at other names in this space. I'm starting to think, here's one, AEP. Now, AEP, American Energy, did form a weekly high close doji. And I say, long shadows. It looks like in here since March, as the market blew to the downside, they've been picking it up, but there hasn't been any strong volume in the market until last week. And the last couple days, we started to see some interesting changes. Now, Person's pivots for the month suggest blue under gold, which is still fairly bearish. When we take a look at the weekly, we see blue above gold. So for me, I would be wondering if the market, especially in AEP, has a small sell-off, a shake the tree before an upside move in a seasonally strong period of time with good volume. If we came back down into the maybe a 50-cent move to the downside from 56.29, get right into the orange level. So I have a lot of support in a weekly chart time frame that I think if we get somewhere into this zone here, you bet your bottom dollar I'll be looking for intraday buy signals if it can pull back into this level here. Now, that's between the 3-period pivot point, which is 55.63, down to the weekly actual support of 55.32. When I look at that and I go 55.32, what would say the difference between the two is probably, let's just call it right into this zone right here, 55.48, somewhere 55, somewhere in here, right? I mean, I can't get too precise on a market, but boy, I'll tell you what, if the market does pull back there, it still forms a higher low, right? And you can use a defined risk factor of about 1% upside projection on this stock. I would say easily we could try and test the top end of the range, which is about a 1% risk to a 4% gain. So in a seasonally strong period of time and a changing of the guard, and even if, and I understand that this is an interest rate sensitive stock, but they also provide electricity, which is a needed product. If they've gotten ahead of the Federal Reserve's interest rate hike and the market got a little overbought here and got a little oversold there, even on a monthly basis, you can see on a monthly chart in this particular utility space, the volume isn't that great, number one, on that decline, and number two, you can see these shadows that people are interested in picking up the market at that level. So when we take a look at where I've defined more or less the buying opportunity, you can see it even on a monthly chart. If somehow we come early in the month down there, we're not giving it a lot of room. Maybe the risk is too, maybe you want to, move your stops a little bit more, put it maybe underneath the monthly pivot for the month of June. That puts it at a 2% risk with a 4% outlook. So even if we stay in this type of a range of the market, looking at a utility stock as we head into the hot summer months, potentially, of where we use more electricity, this might be an area of defense against a market sell-off because utilities still are a defending type of sector. So, any event, I just wanted to go through a couple little things and what I mean by what we have short-term versus long-term discrepancies that's described in our weekly thoughts and review. The AD lines, the McClellan oscillator, still negative. That was pretty ugly, reflective of all of, and let me share that with you right now before the market dings in my ear here on the opening bell. And that would be RS analysis and spreads going through here. Okay, so when we look at this, we note that on a daily chart, man, we've really been under the gun with the advanced decline. And so when we take a look at the weekly, notice that the weekly has now crossed below. It's not oversold, and the 11-week cycle, maybe we can come back up and bounce up again this week and see a one more surge or retest the highs, chop around again as we get into the next 4 weeks, because my cycle analysis predicts or at least projects a high in the market in the first week of July. So what I'm thinking is that we're going to see more grinding action, more choppy environment, maybe bias to the upside because of the longer term charts. But needless to say, I think we'll be looking at markets that migrate into more defensive stocks. So utilities and maybe energy still is in play. And those are the names. And again, everyone still loves technology and everyone still loves the biotech, financials, still the banks. Will be watching to see if they have strength or follow through in the next few weeks. But boy, I'll tell you what, if there was ever a time to be cautious in the market, now once again, John Person has rung the bell. It's time to be cautious. I said I was looking for the S&Ps to, just in a final note, to get up near 5% move by the option expiration or the month of May, which at the end of April I said I might have been overzealous on that one, and maybe by the end of May. So we never hit 5%, but we, technically, I don't know what you want to define as near, but just for the record, the S&Ps from, and which I posted in there just so that people know, not that it would make a big deal, but we actually did see approximately a 4.47% year-to-date gain from the trade from the close of the business on December 31st until the high, which was made at 213.78 on May 20th. That was a 4.47% year-to-date gain. So damn close to that 5% move. Close ain't no cigar. Where do we go from here? I think the overall market still can grind a little bit higher and chop around, and we got to be on the lookout for more distribution type of stock plays. With that said, that concludes this week's planning and scanning, and then we'll get to more of our day trading setups in the trade room for this week in just a few minutes. Thank you all.